Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
So, I explain in my book what I call the 1,000 pip range transitions. That when a trader is able to recognize at least a 1,000 pip range transition, that a 1,000 pip range transition is occurring, that could be very helpful, especially when you're trading leaps. Let's say options that expire. And I know a few years back, ISE did not have any leaps, but I was looking at recently some option chains there when it comes to FX options. And now, if I'm not mistaken, you even have options with expiration date in 2012. And some of them were there even 2013. So you have these leaps that can go a year ahead of time or even a couple of years ahead of time. So if a trader were able to recognize the potential for a 1,000 pip range transition, and we use the methodologies of the quarters theory, can you imagine how much your option premium is going to appreciate if you're capable of taking advantage of these 1,000 pips types of moves from one major large quarter point, such as, let's say, $1.30, all the way up to $1.40 level. Well, most recently, we've seen that happening with the euro-dollar pair several times in just the last year. Since last August, September of 2010, we have seen the euro making a very decisive move and completing the 1,000 pip range between $1.30 and $1.40 in a short period of time, just a few weeks. Again, I'm talking about leaps with expiration date a year, 2 years from now. But again, these moves that the euro did between $1.30 and $1.40 happened in a matter of maybe a couple of months of several weeks. So here's the move here for the euro-dollar pair from $1.30 to $1.40. It even managed to move a little bit higher. That was in November of last year. If you recall, the Federal Reserve here was announcing their QE number 2 announcement that they're going to do another $600 billion of Treasury bond purchases. That put the dollar under additional pressure, and that was the reason why the euro started even breaking above the large quarter point at $1.40. And at that time, it made an attempt to transition its exchange rate from the $1.30s, or the 1,000 pip range between $1.30 and $1.40, into the $1.40s, or the 1,000 pip range between $1.40 and $1.50. However, at that time, prices reached on November 3rd, right here where my cursor is, prices reached as high as $1.4281. Was that a successful completion of the first large quarter of the new 1,000 pip range between $1.40 and $1.50? That large quarter, of course, being the quarter between $1.40 and $1.4250. If prices reached as high as $1.4281, obviously, they have even surpassed the targeted large quarter point. So that large quarter was successfully completed. But I'd like to bring your attention to what happened after that. Now, remember I was showing you earlier, it's very important for prices when they complete a large quarter for them not to break below the previous large quarter point, especially when that large quarter point is a major large quarter point. And what we said in the beginning of the webinar is that these major large quarter points are the important junctions that mark the end of a previous 1,000 pip range and at the same time the beginning of a new 1,000 pip range. So when prices attempt to transition into a new 1,000 pip range, it is imperative, it's crucial for the quarter theory methodology to monitor the price behavior on any type of pullbacks, because on those pullbacks, and pullbacks will occur, on those pullbacks, however, we do not want to see prices breaking below the major large quarter point that they broke above. Because if they do break below, let's say here $1.40 level, all they're going to do is prices would go into the previous 1,000 pip range. So in that case, we are not going to witness a successful 1,000 pip range transition of prices into the new 1,000 pip range. They would simply fall back into their preceding large quarter point. Needless to say, that is a sign of weakness. So look what happens here in November of last year. The euro goes to above $1.40. It goes to complete the quarter between $1.40 and $1.4250. But on the pullback, a couple of days after that, it breaks below $1.40, falls back into its previous 1,000 pip range, and prices stay within that 1,000 pip range. And then what the euro does is simply goes down to complete the entire 1,000 pip range between $1.40 and $1.30. How can a trader benefit here in this example from the methodology of the quarters theory? If we were able to recognize that at this time around, we're not going to have a transition into the new 1,000 pip range above $1.40, where the market or current fundamental backdrop for both of these currencies does not justify a euro-dollar exchange rate at that point being above $1.40, trading between $1.40 and $1.50 or into the $1.40s. Again, these 1,000 pip range transitions are significant development, and I explained that in my book as well. They do not happen randomly because the market just decided randomly that all of a sudden now the euro exchange rate versus the US dollar should be into the $1.40s. It should be above $1.40. There has to be a strong enough fundamental reason for the market to transition that exchange rate into a new 1,000 pip range, for the exchange rate to be above $1.40. If such a reason is non-existent, then the market could very quickly adjust the exchange rate as it did in November of last year, because the focus shifted from the Federal Reserve and the quantitative easing program, obviously that is not positive, beneficial for the US dollar, into, after the Fed announcement was behind us, it happened exactly as the market was expecting. The Fed announced that they're going to do more quantitative easing. Then the focus shifted on the problems with Ireland at that time, if you recall, the second country that ended up asking for a bailout from the Eurozone. And so the euro, obviously, in that type of an environment, the fundamental backdrop for the euro did not justify a euro-dollar exchange rate above $1.40. So a very quick adjustment was made, and the euro-dollar exchange rate fell back into its previous 1,000 pip range. However, let's take a look at what happened here in the last several weeks. Now, the European Central Bank raised interest rates, which is a fundamentally positive development for the euro. It increases the yield advantage for the euro and is a supportive fundamental factor for the market to consider, again, a transition of the euro-dollar exchange rate above $1.40 level. And this time around, let's pay close attention to the price behavior of the euro-dollar exchange rate. As we noted in November, the first large quarter of 250 pips was completed, but on a pullback, prices dropped below and broke below $1.40, so they fell into the $1.30s. This time around, however, not only the first quarter of the new 1,000 pip range between $1.40 and $1.4250 was successfully completed here in late March, but also on the pullback to the previous major large quarter point, prices remained above $1.40. Remember the previous price that we quoted? 1.4019. They reached within 25 pips from $1.40, but they never ever broke below that level. They never went back into their previous 1,000 pip range. What did I say earlier that is? A sign of strength. And it's a sign that this time around, unlike November of 2010, there's a greater probability for the exchange rate of the euro-dollar pair to transition itself successfully into the new 1,000 pip range between $1.40 and $1.50. So now, if a trader wanted to remain more conservative, they would say, one can say, well, great, now the 1,000 pip range, new 1,000 pip range transition has occurred. Now we can expect prices to go from $1.40 to $1.50. Not so quick. If one wanted to be realistic, at least we can anticipate and predict with a greater probability of success that we may not complete the entire 1,000 pip range right off the bat. But after these requirements are met, and let me repeat them again, completion of the first large quarter of 250 pips of a new 1,000 pip range, and then on a pullback, prices do not break below the previous major large quarter point. Those two requirements are the requirements that we must see in order to recognize a successful 1,000 pip range transition. And when a trader is able to recognize a successful 1,000 pip range transition, we can at least anticipate that prices may make further advancement into that new 1,000 pip range. Where to? Well, to what I call the major half point of the 1,000 pip range, which in this case, in a 1,000 pip range between $1.40 and $1.50, the exact middle point or the major half point of that 1,000 pip range would be the large quarter point at $1.45. So let's take a close look here. What happened after the pullback where prices stayed above 1.40? That signals that the 1,000 pip range this time around, unlike November of 2010, is successful. The trader can anticipate with a greater probability of success that prices will make further advancement. And you're looking at a price move of 500 pips. Because each large quarter is 250 pips each. So if two large quarters between 1.40 and 1.4250 and then 1.4250 to 1.45 are successfully completed, by knowing the methodology of the quarter series, especially the 1,000 pip range transition requirements, a trader can forecast that there may be a greater probability for that type of a significant price move. And in terms of option premiums, 500 pips of a price move is a pretty good return. Now, Katrina, are we running out of time here? I see that we have only 3 minutes left until 4 p.m. Eastern time.
Yep, it looks like we're... Yeah, you know what? I think you have a few more slides. If it's all right by everyone, I think we can probably run a few minutes over if you want to just kind of go through the rest.
Sounds good. And the reason I asked is because we have a nice quiz for all of you guys. And those of you who are going to successfully answer the questions, I wanted to show a few more examples, but I don't think I'm going to have a lot of time here. I have the dollar versus the Japanese yen. Ticker symbol is YUK for ICFX options for that currency pair. And you can see that for the majority of the last year or so, the price activity for the dollar against the yen is also taking place within a 1,000 pip range, which is between the major large quarter point at 80 yen and the major large quarter point at 90 yen. And what I wanted to mention quickly is that the numerical representation obviously is different. It's not 1.30, it's not $1.30, it's not 0.80 cents or 0.90 cents and so forth. The numerical representation is different. The numbers are different that are used to represent these large quarter points, these major whole numbers, major large quarter points, and so forth. But despite of the fact that their numerical representation is different, everyone can see and understand that these are constant price levels, constant price ranges that never change. It is a familiar, predictable environment, which is the kind of environment that I needed as a trader to be able to forecast with a greater probability of success the direction of the next price move and take advantage of it and benefit from it as a trader. Now, here's the quiz that I have prepared for you. Okay, where is that slide, by the way? Okay, here we go, the quiz questions. First one is, if you would like, you can write them down, and whoever answers correctly. Okay, here's one answer, and that's a correct answer from.
Wow, it looks like we have a few correct answers. Actually, if you all can just email your correct answers to webinar@ise.com, we should be able to. I'm sorry, webinars, that's plural. If you just want to send over your answers, the first correct 5 responses, we will be sending prizes. So send your responses over to webinars@ise.com.
And the email address is now on the bottom of the screen.
There we go.
So make sure you send your emails right there. And the 3 questions are, first, how many pips does each large quarter have? How many pips are in each small quarter? And the third, more difficult question is, which will tell me whether you did pay attention to this presentation or not.
I hope you all took notes.
I'm sorry.
No, go ahead.
The third question is, what is the main premise of the quarters theory? So hopefully you'll be able to answer all of them, and the first 5 who answer correctly and email to webinars@ise.com will receive prizes. Great. All right, we look forward to getting your emails, guys. Katrina, I'd like to thank you for putting together the webinar today. It was a pleasure to be back and do this presentation for the International Securities Exchange. Thanks to all of our attendees. And if you do have any further questions, if you would like to listen to my daily analysis when it comes to the currencies and foreign exchange market, make sure to join me and listen daily to my All Things Forex live daily broadcast on my website, www.allthingsforex.com. Now, this is a little bit of an older graphic here and an older slide. We have a new time frame for 2011. The actual live program is now from 8 a.m. until 9 a.m., Monday through Friday, 8 a.m. to 9 a.m. But not to worry if you're working during that time or if you're not able to attend the live webinars or live broadcast, you can always go to allthingsforex.com and listen to the archives. We have archives going back a month. 8 a.m. Eastern Time, 8 a.m. Eastern Time, 8 to 9 a.m. Eastern Time, Monday through Friday. Because the broadcast is basically syndicated on 10 or 12 other different websites around the world, we also archive it. We record the live trading session, the live broadcast, and then we replay it in a loop for the next 12 hours. So you can listen to it that way, or you can simply go to allthingsforex.com and you can access the archives. And a lot of people actually download. It's an MP3 file, and you can download the archive of the program and listen to it on your iPod and many other devices. Once again, thank you all very much for being with me today. Thank you to International Securities Exchange. Thank you, Katrina. And I look forward to seeing you soon.
Great. All right. So thanks again to Ilian for teaching us a little bit more today about the quarters theory. Thanks to all of you for joining us. If you'd like to learn anything about the FX options that we discussed today, please visit www.fxoptions.com. We do have a lot of resources there available to anyone who's interested in learning more about the various currency pairs. There are free trade alerts that you can sign up for if you're not really totally familiar with the product. We do have podcasts. We have a lot of content available there, so please be sure to check it out. We do hope to see you at our upcoming webinars. We will have another one next week, so make sure to visit the latest schedule at ise.com/webinars. Thanks again to everyone, and I guess we'll just see you next week. Take care.
Bye-bye.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.